Hey, this is Chris, and in this video I'm going to be talking about the 4 key options available for people looking to get access to the share market in Australia. And some of the pros and cons of those options, some of the trends that have been emerging, and ultimately the option that we think is the best option for most of our clients. So the 4 options are buying direct shares on the share market, buying into managed funds, and those managed funds could be listed managed funds or unlisted managed funds. The third one is buying into listed investment companies. And then the fourth option is exchange traded funds or ETFs. So these days there is a great choice available. When I started investing back in the late 90s, it was a lot harder to access some of these options. Really the only 2 options available were direct shares or buying managed funds. And I think a lot of people back in the 80s and 90s and early 2000s gravitated towards buying direct shares. You know, this was the time in Australia where a lot of companies were listing on the share market. There are a bunch of IPOs from Woolies, from Telstra, CBA many years ago as well. So direct shares were really the core of a lot of people's portfolios. A lot of people have done very well out of direct shares because a lot of those great companies still exist today. They've grown very well. There haven't been too many of those famous floats in Australia that have gone belly up. There has certainly been some that have underperformed. Myer is a great example. I remember when they listed and they haven't done very well. But direct shares has been a great way for people to invest. The main downside I see of direct shares is that they tend to be a lot riskier than diversifying using one of the other 3 options. So direct shares can potentially mean that you're very prone to market cycles, particularly if you have a lot of money invested in only a small number of sectors. So historically in Australia, people have owned a lot of banks, a lot of resource shares, maybe some Telstra and Woolies in there as well, but really it means you're very exposed to the Australian economy, to those Australian businesses that may work in some parts of the cycle, but there's other parts where it doesn't. So a trend over the last few years has been that more Australians have been investing overseas. There's a lot more stockbrokers now offering, relatively inexpensive ways of accessing US shares, for example, and particularly as the technology sector in the US has boomed, there's been a lot more money gravitating towards global shares. With global shares, they give the added benefit of a bit more diversification, so you can spread your money across other sectors. The risk is that you can still see a lot of volatility in your portfolio, and that volatility is enhanced because of foreign exchange. So when you buy a share on the US share market, you're not only taking a bet on that company, but you're taking a bet on the exchange rate between the Australian dollar and the US dollar. So direct shares is an option that's becoming easier and easier to access. The costs are coming lower, but actually money I think is gravitating into some of these other options because people are seeing some of the risks of direct shares. There are lots of companies that go bankrupt, and the studies show that actually most companies listed on the share market underperform. And so to actually guarantee you've got access to the winners, people are gravitating to more diversification, which takes me to option 2, which is managed funds. So managed funds, like direct shares, have existed for a long time. Typically these are managed by a professional team of fund managers whose skills reside in trying to time when to be in and out of the market or particular companies, and also which companies to buy. So there are some very well-known famous fund managers in Australia. The big trend in funds management has been that it's got much, much harder over the last 20 years though. So where there are some famous fund managers that had very consistent performance back in the 80s and 90s, we haven't really seen that since then. There's been some fund managers that have done well for a while, but then done really badly for a while as well. And actually it's very difficult to work out when to be involved in one fund manager and when to get out of that fund manager, because their performance tends to be quite style driven. So a fund manager might like, for instance, good value Chinese shares, but unfortunately if good value Chinese shares have a bad 10 years, that fund manager is going to go badly for 10 years. Likewise, if a fund manager likes high growth US tech shares, if that sector is doing well, fantastic, they'll do well, but ultimately the performance of that fund is mainly driven by the underlying sector returns and performance. Which takes me to the third option, which is listed investment companies. Now, in many regards, these are quite similar to managed funds. One of the main differences is that where some managed funds are listed on the market and some aren't, all listed investment companies are, by their very definition, listed on the share market. There are some very big, well-known listed investment companies in Australia, but they tend to vary a lot, from ones that are diversified across the whole market to ones that have very concentrated, and then there are listed investment companies that have very low fees to ones that have very high fees. one of the big challenges with listed investment companies is that they're closed-end funds. And what this means is when you buy a unit in one of these funds, you actually have to buy it off another investor, and the price might not always match up with the value of the underlying investments in that fund. And what's happened over the last 10 or so years in Australia is that a lot of listed investment companies have started to trade at deeper and deeper discounts to their net tangible assets, or the value of the assets within the funds. And this, I think, is actually quite a sensible thing, because investors are actually discounting the value by all of the future fees they're going to have to pay the fund manager. So investors are actually wisening up to the fact that these aren't great investments because of the large fees, and they're attributing a bigger discount because of the present value of those fees today. So while I think some people think listed investment companies are great because you can buy $1 at 90 cents, the problem is it will probably never trade at $1, because people will constantly be worried about the fact that you're going to owe many, many fees to the fund manager over the future years. And actually, if the share market earns something like 8 or 10% a year, but you're paying a fund manager 1 or 1.5% a year, these things should really trade at a big discount because of that loss in fees over the long run. And that's why I think a lot of money now has been shifting from LICs into the next category, which is exchange traded funds. So particularly since commissions have stopped being paid by stockbrokers and other financial professionals to bring LICs to the market, there's been a wave of money moving to low-cost index funds, or ETFs. Now, ETFs, rather than paying a team to pick stocks, you're getting a broad range of companies that track an underlying index. So that could be an index of shares, of bonds, or it could be a single asset like gold or a precious metal. The great benefit of this asset, or this way of accessing assets rather, is that it's extremely low cost. It's very transparent, you know exactly what you own always. But also it's pretty tax efficient, because unlike active funds and LICs, there tends to be very low portfolio turnover, which means as an investor, you tend to inherit much lower capital gains, which is great because you don't have to be paying the tax office, and you can continue to reinvest as your money grows. So we've seen a lot of money going towards ETFs in Australia. Since I started Stockspot, when ETFs were only about a $10 billion industry in Australia, they're now a $130 billion industry. So in 10 years, they've really grown a lot. But even so, Australia is still behind North America and Europe when it comes to adoption of ETFs. So I think there's a lot of great growth ahead. The benefit of ETFs is that they give you access to a specific asset, and they allow you to build a really robust, diversified portfolio. So we combine a range of different ETFs that cover different asset classes, like Australian shares, government bonds, global shares, emerging market shares, and gold. And by actually combining them, it can give you a smoother ride for your investment journey over the long run. So it allows anyone to really access these great tools and build a professional quality portfolio, which is very exciting to me, and ultimately why I started Stockspot, because I wanted to be able to provide these awesome, very well constructed, professionally managed portfolios and make them available to everyone. And they're the 4 key ways of investing in shares in Australia.